one. Man, I'll let you guys read through it. It's not very long. Okay, so let's go through these questions here. Which incompatible duties did Jeffrey Ganzwicki, Ganzewski? I don't know. Ganzewski, I think. Let's call him Jeffrey. What incompatible duties did he have?
I would say 2 and 3, authorization of record keeping.
Yeah, he probably had all of them.
Probably, yeah.
Because, and the reason I say that is he obviously had control over cash because by changing the terms of the loan, it was allowed that $2 million on overdrawn accounts was covered. So he did have the ability, maybe not directly, but certainly indirectly, over cash. So authorization definitely, and because of the kind of lack of oversight, it basically would go into the record keeping too. So probably all of these, but yeah, he even had custody of the assets. custody just means you have control over it. So
Yep.
now, there's one of those strange things. The fraud components, they usually say, they call it the triangle of fraud. They have opportunity, the need or pressure, and then concealment. So he obviously had the opportunity. He had all three of the incompatible duties. What was the need or the pressure? Why did he do it?
To help people.
He was trying to help bank customers.
Yeah. And this is one of those things that you might think that this is fairly rare. It happens. I don't know if it happens a lot, but it definitely does happen. One of the things about the need or pressure is oftentimes it's somebody who's going through, they're losing their house, they're going through a divorce, they're going through whatever it is, that there's a financial need to do it. And they also go along with that, some kind of a rationalization. Well, it'll all work out in the end of it. But anyway, the most important thing though is that they see that there is something that needs to be done. And again, it's not that uncommon to have someone trying to help somebody. It is as strange as that sounds, and this guy is facing years in prison for doing what I'm sure that he felt right. Like, okay, I'm doing this, I know it's wrong, I'm covering it. That's where the concealment comes in. And the concealment, of course, was him. He changed the terms of the loans and stuff. He falsified the documents, even signed some of them. Yeah, so the concealment is a kind of an obvious one too. And so all right. What other factors likely made this possible?
I would say lack of internal control that the bank had.
Yeah, definitely. Lack of internal control. And go ahead.
No, sorry, I'm done. That's what I'm thinking about.
Yeah, certainly there was a lack of oversight, lack of some kind of review of some of their work. Now, so these are all true. But one of the things that is also true is this is not a really large bank. Large banks, they usually work in billions. They usually have total assets in the billions. Even fairly large, regional banks will have that. Really large banks are in the trillions. This is a small bank, which makes controls more difficult, and it makes segregating duties more difficult. Um, it's very common to have small companies that have difficulty segregating duties because they just don't have that many people. I don't, and I didn't see how they don't think they said how many loan officers there were, but it could have been, well, he's a bank VP, you know. Um, my guess is there was no one really reviewing what they were doing. But I will say this though, I don't know if you guys ever dealt with banks. A lot of times they give higher titles to people than they normally would. Sometimes you'll be in a bank where virtually everybody's a director, the director of this, the director of that. So having big titles, and then one of the reasons why they have big titles is just obviously from a marketing point of view. Oh, I'm dealing with the vice president, that kind of thing. But anyway, a lot of times it's hard to segregate duties, and this is probably not a big bank. My guess is they probably have less than they probably like, I don't know, man. I'm just guessing maybe 20 employees, if that. But so when you get to having those, you get to having very few people, especially in management, segregating the duties becomes very difficult. And this guy probably wasn't flying, wasn't driving around in a Ferrari or something. It wasn't like they would suspect, oh, this person's embezzling money, from the place. So one thing flying under the radar. And one of the common characteristics of people that commit fraud, they come in other shapes and sizes, but one of the common ones is they're usually very hard workers. They're the person that's there all the time. They're very in control of things, and so it's very difficult to find out. Is this person a fraudster or is this person the best employee we've ever had? Because they're both going to look the same. So, okay. Oops, no, not that. Yeah, so small businesses, though, in general, have a hard time segregating duties. Okay, let's go to the second one, the slammer case. This one's a little longer. Okay. So you got this golf club that apparently when it gets hot, 150 degrees, the head comes off. And if you think about golf clubs in general, it's not uncommon to have people throw them in the trunk of their car, and that can get very hot. That could, that could get up to 150 degrees, I'm sure. So you got this club that is, it possibly has a lot of liability attached to it. And there's a few things going on here that makes it tricky. First of all, one thing about being in a CPA firm is, even though you're auditing the clients, you got to remember the clients are what's making the place profitable, what's making the CPA firm profitable. So there is this somewhat this thing that, if you don't have any clients, you're not going to be a CPA firm. You need to have clients. So you don't try to irritate clients. But again, you have something like this where you have some problems that are going on with it, with the audit. And by the way, almost all audits have something wacky happen. They just do. They're never cut and dry. There's always some wacky little twist that gets thrown in. So that's not uncommon. Now, another thing is that auditing in general is judgment. It is. It's all judgment. The sampling is judgment. Even if you take a specific sample, okay, we're going to be 99% sure, whatever. That's a judgment call. It's all judgment, which is why it's hard. Which is why it's hard to. Well, it's hard to teach, but which is why I like teaching it. But it's also difficult to, to pass on to people, because you're kind of teaching is judgment when it comes to auditing, and what is material, what isn't material, that sort of thing is hard to sometimes quantify. We can do it in accounting, pure accounting, where you say, okay, here's the mortgage, this is the payment, this is the effective interest rate, and you should all come out with this number. That's that's what we're kind of used to in audit, in accounting, but auditing isn't like that. So it is a judgment call. Now, there are a couple things in here though that are a little bit concerned. Well, why don't you tell me what's the most concerning? What are the more concerning things about this?
The way the senior auditor responded to the information that was given.
Yeah. Now, you'll notice up here, the senior manager was not happy about the information. And a few days later, came this conversation down here that they said, "Oh, don't worry about it." Every manufacturer, and there are in businesses things they call general liabilities, basically, of being in that business. If you manufacture cars, there are people who are going to get in car crashes. It's going to happen. That's a anyone who's in the car business, there's going to be car crashes. And so, and they're saying, look, in sporting goods, hey, you're going to get lawsuits. There's going to be, just the nature of the business. So there are these kind of general liabilities that are built into any company that's like that. So there is some truth, there is some truth at all, I'll be, they manufacture baseball bats or whatever. There's liability involved. The question is this supposed to be excessive? And that's a judgment call, if it is or not. So this is definitely one thing. Now, the fact that this happened a few days later what do you think happened in that time? So the auditor went from being not happy about the information to a few days later saying, don't worry about it.
So basically the senior auditor took it to the company, and there was like a discussion there as far as trying to ignore it.
It could have been discussions with the client itself. Could have also been discussions, you know, because this is auditing and it is a judgment call. It also is possible he went to the manager or even the partner and asked about it. So it could be, you don't know where this is coming from. It could be, you're right, it could be discussions with management of the company saying, hey, you know, we're a sports company. What if you're regarding a car company, they're gonna have car crash. If sports, you're gonna have sports injury. This is, you know, nature of the business. So you're not really sure exactly where the seniors, you know, where the senior landed. And the senior may have very well have talked to somebody in the CPA firm, you know, either a manager or even the partner, and was told not to worry about it themselves. So you really don't know exactly where they're coming from. Okay, and the senior asked for all the notes for it. This probably isn't that, this sounds more ominous than it really is. If they aren't doing the liability portion, which it sounds like the senior might be doing it, because the senior's talking with the legal counsel. You do want to kind of have, you don't want to have 10 people looking at the, you know, you got to figure out who's going to be taking that. And it looks probably the senior, I imagine, was taking that part of it. Okay, there is something in this paragraph that's actually fairly concerning. And this is just the audit in general.
The fact that the employees were basically told not to speak with the auditor.
Yeah, this is actually a very. Oh yeah, no, I didn't want to do that. Trying to make it yellow. There we go. Yeah, this is what they call this is a scope limitation. This is when the client doesn't allow you to get information that you want. Now, it is true that, you know, this part of the audit was taken away from you. But whenever there's a scope limitation, it's a red flag. Oops. So a scope limitation is when the client does not allow you to see something. And it's sort of like there's a murder investigation. They come to my house and say, we're investigating murder. You said, yeah, you can look through the house, but don't look in this closet. You know, well, the first place you want to look is in the closet. And it's the same thing with a scope limitation. If they don't want you talking to these engineers, that's those are the first people you want to talk to are the engineers, because why are you telling me not, why are you telling me that we can't talk to the engineers? So whenever there's a scope limitation, especially when it's put on by the client says you can't do this. That tends to be a problem, because that is a scope limitation. That's a limitation on what you can look at to get a picture of what the company is. So even though that one may not seem like it's that big a deal, that one actually is a pretty big deal, because that is, again, everything has to go through whatever the vice president of operations, whatever it was, I can't remember now. Okay, so manager comes in to review the audit. And the manager made a few minor suggestions for follow-up work. Senior did not mention the Smasher, nor was it in the work paper. So apparently everything about the Smasher Club disappeared. Yeah, audit manager asked if there was anything exciting she should know about, and no one said anything. It sounded like. All right, so you believe the audit manager should know about the Smasher problem. All right, so this is, and this is one of those things, even though this is for a very specific thing we're talking about, it could be for anything. It's not uncommon to go through an audit and you think something's important and your supervisor doesn't think it is. It also goes the other way. There are some things that you think are not important that your supervisor thinks are important. I remember doing a petty cash fund audit where they had $10,000 in a petty cash fund because they frequently had to pay trucking firms when they came in. It was a research place, and they got trucks from all over the world coming in, something all over the world coming in trucks, and the truck drivers would basically say they have to get paid in cash or else they turn around. And these are small firms, a lot of times they're doing it. So anyway, they had petty cash that was $10,000. It hadn't been counted in 2 years, and I counted it, and it was off by $10. And the audit manager was he got kind of excited. I think you gotta be kidding me. I was like thrilled. I thought, if this thing is, if it's off by $200, I'd be happy. But anyway, so sometimes it goes the other way too. But anyway, the real point of this though is, what do you do when there's a difference? What do you do when there's a difference? And it really falls to a difference of judgment. You think this is important, this person doesn't. When it goes the other way, it's not that big a problem. So when I did the audit, I wrote up we were off by $10 on the petty cash fund. But when the question is, what happens when you think there's something wrong that your manager doesn't? Now, there have been there's actually is a new way of, we'll go through this. Okay, so how would you communicate smash a problem to the audit manager, and where would you? I guess the first question is would you answer, would you communicate this to the audit manager?
Yes.
Yeah, this is probably something they should know. Now, remember, they may already know about it, right? I mean, you don't know back here. You don't know if this came from that very same audit manager. So yeah, I would say you'd want to communicate this. Again, that's a judgment call, though. And the question is, how would you do it?
I think that all depends on the person.
Yeah, it probably does. This is a very touchy situation because, notice that in some ways you're going around over the head of the senior, right? So this is always a very tricky, well, not just in CPA firms, but any business. If you go over your boss's head, you never know really what's going to happen. And while you might think you get a pat on the back, a lot of times they look at it very differently. So you have to be very careful about how you do it. You could kind of phrase it as a concern, sort of that kind of a, I'm a little bit concerned about this part of the audit, whatever it is. And again, you got to be a little bit delicate because it may have come from the audit manager to not look at it. Another thing is, this may not be an isolated case. This might be something that has gone on often with this client, and maybe this is just business as usual. And here's another thing about auditing: because it is passed down judgment to judgment to judgment, the new people coming in, they're kind of indoctrinated to whatever the judgment are of that CPA firm. And if they have great auditors, the judgment's gonna be great. If they have less than great auditors, a lot of times it's less than great, because it is this passed down thing, passed down about judgment from basically generations of auditors. And by the way, the generations happen pretty quickly because they turn over every couple of years almost. They turn over the associates anyways. So, it isn't uncommon to have this be, in 10 years, you could easily have this go through 5 generations of auditors where this becomes the standard practice. Hey, don't worry about it, that kind of thing. So you don't really know where it's going. I think I told you there's another case I had that, or not I didn't have it. It's a very famous case called Parmalat, which is the largest corporate fraud ever. Not as big as Madoff, but it was like a $10 billion fraud. It was like bigger than WorldCom and Enron combined times 2. But anyway, when they handed out the indictments for it, they had, I think it was 78 auditors were indicted for fraud. 78 auditors, the audit people that came in to check the books, 78 of them were indicted on fraud because it had just been passed on. This is just the way we do it. Oh, don't worry about that. On like that. So it's not unusual to have this be kind of almost like corporate generational go through there. Okay. Hey, I was not letting me. Okay. How would you be able to defend yourself? There actually is a bit of evidence that even though the senior took all your notes, there is a bit of evidence that it's out there.
The video.
The video's out there. You don't know what's happened with that. But yeah, if you get your hands on the video, that would be great. And there's one more. You can still look at the financial statements of Hammer. And remember, they got this note about liability. And it accounts for 70% of Hammer's revenues. So if they have something, for liability and you're looking at someone who's supplying 70% of their product, that could definitely be, sports engineering. So you do have some evidence, even though you don't necessarily have your notes. You do have some evidence. So there is some evidence that exists. And you can tell the audit manager about the video and have the audit manager ask for it. So the video and the Hammer financial statement notes. And what would you recommend that the audit manager do about the Smasher Club? And what course of action could the CPA firm take? So, let's say that your concerns are valid. Maybe that what they're looking at here is a large liability. What course of action would you recommend to the audit manager?
Could recommend that they account for the liability as far as like insurance purposes.
Yeah, the first thing you could do is put a liability, even if it wasn't a specific amount, it could be in the footnotes. I should say the CPA firm could insist. Another thing they can do is it can be added on to the audit report. It could be called different things. It could be called a critical matter. I'll also. Too many T's in there. I did put too many T's in there. They're actually at the end of the. They used to call it emphasis of a matter. I think now they call it critical. They call it emphasis of a matter. So you can actually, the audit report actually allows you to put in things that you think are important. Even if you're giving a clean audit, you can say, oh, by the way, there's this liability here. Okay, so those are a couple things that they can do. It could be that, it could also be that they think that the financial statements are misstated. It would be kind of hard to do that without some kind of dollar amount, put on this. Okay, this one has actually changed since I wrote this case. If the manager ignores your concerns, you take the step up to the firm's partner. Okay, at this point, it becomes a little bit, this is a little bit more dicey. And by the way, a lot of times partners, well, a lot of times they'll review the audits and stuff like that. The partner's job is to get clients. That's their job, is to get clients. So, a lot of times stuff like this, well, did you talk to the audit manager? Well, go talk to the audit manager about it. That's sometimes what you're going to get, because another thing about being in CPA firms is that it's such a all-encompassing job that partners will put in 60-hour weeks at least. It's just the nature of the business. But their whole thing is getting clients to come in. So a lot of times the actual nuts and bolts of the audits are not really what they're concerned with. They'll say, well, that's what the audit manager is for. Talk to the audit manager, that sort of thing. Now, here's the thing that's different than when I first wrote this case. It's different because now the AICPA said that you are allowed to have dissenting, I don't say opinions that are like the written opinion, but a dissenting view on given topics, and put those in the work paper. So you can actually insist on, anyone in the audit can insist on putting in a dissenting view into the work papers. Now, that's also kind of a big thing. Notice the work papers are there so that when you go into court, you can say, we did our audit, we did our due diligence, look at our work papers. If there's a dissenting opinion in there that relates to this, that could be a real problem with your case. Well, look, you had people that did the audit that even said that this is wrong, so it does become a little bit more trickier to do that. And you should think hard still before doing it, but you actually can put a dissenting opinion, I didn't say opinion, a dissenting view on a given topic, and you can insist on having that in the work paper. So the AICPA allows you to have that right. Again, it's still something you need to think about, but it is an option. So, and this is part of the quality control thing, so that if you are, the idea is that everyone working in the audit should be able to have their kind of their opinion there of any certain topic put in there. I shouldn't say opinion, dissenting view or dissenting judgment, maybe is a better way to put it, allowed in the work paper, so you can document that. And part of the reason for doing that is that, you know, they you know, kind of like being painted with the same brush, you know, that everyone on that audit, if something happens, everyone on that audit is suspect. You know, why didn't you catch this? You know, how could you not catch this? Everybody on that audit. And so part of that is, you know, look, I put a dissent in, you know, I knew this wasn't right or whatever. So you can actually put that in there. That is an option that is given to all people who are participating in the audit. Now, again, all of these things we're talking about, though, you know, it isn't lost on a lot of people that these are all things that could limit your career. And it does happen sometimes that, you know, people, you know, like I don't want, you know, I don't want him or her on the audit because they're just gonna, you know, I don't want to sit there and go back and forth with these people. You do run into that. So it is, while it is available and these things are something you can put it in the work papers, you know, against the wishes of anyone else on the audit, it is something you need to think about. And again, you know, for judgment call. It does happen that you do have people that are, you know, very diligent who will come up with different opinions, and sometimes in a really good way. There was the CPA firms. One of the things that they got sued on a lot was that they would only hire young people coming out of college. You know, if you were, you know, 22, 23 coming out of college, they might even look down on that, like maybe you're a little too old. It was really that, you know, you had to get out of college in 4 years. They expect you to be like 22 years old, unless you got your master's degree. Then you could be, you know, 23 or 24. But and so they got this, you know, it was an age discrimination thing. So one of the things was they hired, there was this older woman who decided she wanted to be in a CPA firm, and I think she was in her 40s or 50s. Anyway, she was at the bank and they're trying to explain what about this account, and the person who she was talking to kept saying, look, it's a clearing account. It's because we have these transactions overseas. They come over, you know, if there's a mismatch on the currency exchange or whatever, that, you know, it goes into this account. Those accounts are always, you'll see that account, you know, it goes up and down, and, you know, he kept explaining it, and she said, this doesn't make any sense. Doesn't make any sense. They were ready to let her go because she wasn't savvy. And it was in the work papers for like 10 years that was a clearing account. And she finally got to talk to the chief financial officer. Chief financial officer took one look at it and said, you're right, there's no reason for this. And it ended up being like a $10 million fraud. That this, you know, this person was literally stealing like $1 million a year and putting it in this account that was supposedly a clearing account. So there is something to be said about people who are diligent and don't just say, okay, well, this is, you know, here's the judgment. Look, you know, we've known about this account for 10 years. You know, give it up, you know, that sort of thing, because no one ever really looked into it. So anyway, but that is part of it. And that's kind of the, I don't know, you know, the business, whatever, environment, social environment of it. Okay, oh man, did I talk too long? I'm stupid. All right, I tell you what, we'll go ahead and take a break. We'll come back and we'll start in on chapter 16. So let's say be back at, what time is it? Be back at 7:01. Okay, so just to tell you, I'm kind of, when you wrapping up the audit is what we're gonna cover next. Part of wrapping up the audit is searching for liabilities. There actually is a section in the book about testing for liabilities, but I'm gonna put it in this section here. There's not too much in it. But at the end of the audit, one of the things you have to do is search for unrecorded liabilities. We've already talked about some of it. So searching for unrecorded liabilities. I think I mentioned this before when we were doing the cash chapter. What's one way that we search for unrecorded liabilities? It has to do with the bank. Maybe we didn't talk about it. I don't know. A couple things from the bank that we would use. Oops. One is the a bank will have the loan terms on it. Okay, so standard confirmation is one of the things you'll look at. I remember we had the bank statement. And you recall that that's usually done, say, 7 to 10 days. I say 7 to 14 days. In the new period, and it will show oops. So for instance, if a payment went through on January 10th, it's very likely whatever they're paying for was actually should have been on the books on December 31st. Because usually there's a delay, 30 days or whatever it is between when something is paid and the transaction happens and something is paid. So if something happened early in January, if a payment was made, it's very likely that that payment was for something that was on the books earlier. Not necessarily 100% sure, but it's a pretty good guess that that's going to be the case. So if you have a payment that doesn't match up with a liability that was on the books, that could be, it could be an unrecorded liability. How does that happen? Someone gets a bill, instead of putting it in the accounting system, they stick it in the drawer. Right? So it doesn't go into the accounting system. After year end, they pull the bill out. Oh, geez, we got to pay this. We got 3 days to pay it. They write the check and they put it in the mailbox in the following period. So searching for unrecorded liabilities, one of them is through the cutoff bank statement. Okay, how about this question? How many monthly utility bills should the client have in 1 year?
Well,
12. So one of the things you look for is the number of entries and, for phone bills or utilities or whatever it is. That usually if they're on a monthly payment thing, it could be, payments for whatever. If it's monthly, then usually it's 12. So you look for 12 payments. So how many monthly bills there should be? Okay, now a couple of analytical ones. Let's say they're showing loans of $100,000. Interest rate is 10%. And taking it up a little bit. I'm gonna make a mess out of these. And the interest expense is, I need more room. So you look at the loans, they have $100,000 in loans payable. I should say payable here. The interest rate is 10%. Oh, come on, it's not coming back up. And the interest expense is 6,000. So what's unusual about these amounts?
interest expense should be 10 grand, so we're missing 4.
Yes. It should be 10,000. Right, if this, if you get the loan statement, whatever, and it says that this is, that their borrowing rate is 10%. Then how come the interest expense is only 6,000? So it could be that they're putting the interest expense as something else. There's also the possibility that there is a interest-free loan coming from, an owner or somebody, related party. An owner or somebody in the place is giving interest-free loans to the company, which would make it look more profitable than it really is. So the problem is, first of all, it could be the interest is being put in the wrong account. There's a problem with the journal entry for the interest, but it could also be that maybe they only have $60,000 in loans from, say, the bank. The other 40,000 is an owner just throwing in 40,000, not charging any interest. So especially if you're looking for things that are loans, and if they don't have any stated interest on them, that's a problem too, obviously. But it could just be that that's really not, so much of a loan as it's more like an investment from the owners. Okay, let's give the opposite situation. Loan payable, 100,000, interest rate 10%. And 15,000, so much that goes on the next page. Yeah. You know what it is? I got these big giant, I don't know why I made this into 14 font. That's kind of nutty. But anyway, so the problem about this is again, the interest rate should, or the interest expense should be 10,000. So what would be the danger of this? You have a loans payable of 100,000. The interest rate is 10%. They're showing interest expense though of 15,000. What would be the danger of this one?
Overstating the interest expense.
Could be overstating the interest expense or understating the loans payable. It's possible they have more loans payable than they're actually showing
Yep.
on their book. So it could be overstatement of interest expense to make themselves look less profitable. So these are some ways that we search for unrecorded liabilities. You know, things that they should have on their books that they don't. And a lot of times these occur after year end because a lot of times that's where you'll find that they'll actually be making the payments for them. Okay, so coming out here, you'll also review the minutes of the meetings. Oh, by the way, what are the minutes?
The meetings for the board meeting, something.
Yeah, but yeah. So there's like a board of director meeting. It could also just be a senior management meeting or something like that too. But when they talk, they say minutes. What do they mean by that? What are those? These are just the notes. So minutes are just the needing. There should be a question mark, by the way. Why aren't you guys answering my question? Question mark. So that's just the meeting notes. And you're looking for minutes of the meetings. You'll always look for the board of directors meetings. I'll tell you something about CPA firms. Oftentimes when they have board of director meetings, the CPAs are invited to the meetings as observers. So you'll see a couple of people in suits on the side, you know, taking notes casually, and those are a lot of times they'll be the CPA firm. There's nothing wrong with that at all, by the way. It's just it's a common practice, and one of the reasons why companies do it is because they're going to ask for the notes anyways, and it just saves a lot of time. Why don't you just go to the meeting and so but anyway, the notes of the meetings, those should be made available to the auditors so that they know exactly what's going on with what it is. So reviewing those meeting notes, and you're looking for things that are big, usually things that are going to change the company, programs that they have that are seeing a lot of money into, all that kind of stuff. Things that are material are really what you're looking for in those notes of those meetings. So you're generally looking for kind of big stuff in the meetings, and usually something like board of director meetings or even senior management meetings. A lot of times they'll have, you know, these will be for material decisions, not for little stuff usually. Okay, Identify loss contingencies. What do we mean by contingency?
Things that's most likely to happen.
Yeah, they're usually contingent on some type of event. A lot of times when we talk about loss contingencies, we're talking about lawsuits to some extent that, you know, someone was injured using your product. It's possible that it's contingent on them filing a lawsuit, whether you are going to have to fight against it or whatever. So contingencies are usually something that is depending on something else. And it could be a law case, you know, it could be a lawsuit. We'll talk about that later. But it depends on some action. And sometimes there'll be one of the things is unasserted claims. You know, that there is a unasserted claim in there. Now, sometimes these don't have dollar amounts that can be reasonably estimated. And if they don't, they should still be in the footnotes. Yeah, footnotes. Now, here's one way that the US companies are very different than other companies around the world. Our legal system is way different than any place else on the planet. Other countries, they don't have multi-million-dollar lawsuits. If someone's injured or someone's killed or something, they have kind of a tables and stuff that they use to determine how much the company's liable for. You don't have these 5, 10, $50 million lawsuits that come out. So one of the fights you're going to get with a client is they say, look, we can't put that on the books, because if we put that on the books, then we are going to get hit with a bunch of lawsuits. You know, if we say that there is a contingency because of some defective product we make, you know, that footnote could trigger, and it's as an admission that our products are defective or something like along those lines. This is one of those things, again, that in other countries they usually don't have too much of, because it's not, the lawsuits are usually not enough to bankrupt a place, whereas in the United States they certainly can. So you run into, you know, this a lot, that there's more of a fight against this in the United States than there will be in other countries, and that's just because of our legal system. And on that note, that's why talking to the client's lawyers is so important in the United States. As a matter of fact, if you are not allowed to talk to the client's lawyer, you generally give them a disclaimer, because it's so important in the United States that you do talk to them. All right, see lawyer letter L. Let's see here. All right, general risk contingencies. We already talked about this. General risk contingencies do not need to be disclosed. I used the example earlier that car companies will have car crashes. Whether they are, you know, at fault or not, those do not need to be disclosed. So general risk contingency, whatever they are, it could be, you know, if they're a fireworks factory, you know, anyone who invests in a fireworks factory knows that they're dangerous and that you got to handle them carefully and all that. And if a warehouse blows up, you know, that is a general risk contingency. They're dealing with explosives. So general risk contingencies need to be disclosed. If they're not general risk contingency, and that's kind of what that Slammer case kind of came up against is that, is this just the normal risk of having a sporting goods business, or is this beyond the general, risk contingencies? Judgment call. Okay. Perform analytical procedures. Okay, analytical procedures. First of all, they're required. I'll tell you what they are in a second here. I think I already talked about this. Maybe I didn't. They are required at the planning stage and the ending stage of the audit. Analytical procedures are based on plausible relationship between data. It could be financial or non-financial. I'm gonna move that down to a second. This is one of those things that's almost easier just to do one and figure it out rather than talk over, go through the definition stuff about it. Okay, so down below are the unadjusted balances or unaudited balances of 3 accounts at the beginning of 2023. Okay, so they looked at these accounts, and so this was done at the beginning of the audit. They looked at these accounts and they said, whoa, that's unusual. The sales went down, but the cost of goods sold went up. Right? I mean, usually if sales go down, the cost of goods sold go down. In this case, the cost of goods sold went down. Scratch that. Sales went down, cost of goods sold went up. These usually go in the same direction. What you paid for the item is usually a percentage of your sales. So it's a little unusual to see this. So initially they thought the cost of goods sold might be wrong. Okay, so they did analytical procedures and they said that the cost of goods sold is probably overstated. That this number isn't right. During the audit, it was determined that the cost of goods sold was not materially misstated. However, sales were materially misstated and should have been 1.2 million. Okay, so they look into it, cost of goods sold's fine. They find out, oh, the sales should have been higher. So they tell the client to ask the client to change their financial statements and put 1.2 million in the sales, and the client does. Now, this brings up another problem, though. Looking at these numbers, what looks strange now, they did what we asked them to, but what looks strange now?
The selling expense.
Yeah, usually if you sell more stuff, usually there's more advertising. More advertising, or if you're paying commissions, more commissions are paid out. So the selling expenses. Selling expenses will usually be related to sales, and that's not what we're getting here. It looks like they went down. So one of the things we always do at the end of the audit is you look at the financial statements again and see if they make sense. And you very well may look at this and say, you know what, we got to look at those selling expenses now. They made the changes we asked them to, but now these selling expenses look strange. And let's see, it could just be that, these are, you're right. One thing about analytical procedures is they're not evidence of fraud usually. So you say, why do we do it? Analytical procedure. So, why do we do it? We do it because if they point in the direction of where to look. And something like 95% plus of all material misstatements are found through analytical procedures. Some say it's a little lower than that, some say it's higher than that. So something like 90% of all material misstatements are found through analytical procedures. They tell you where to look. Okay, look here, this is strange, whatever it is here, this is strange. They tell you where to look. However, they are not evidence themselves of a material misstatement. So they are not, I should say misstatement, whatever. It's confusing enough what I have. Okay, so okay. Subsequent events. These are things that happen after the audit. They come in two different flavors. Subsequent event type 1. For example, eh, the lawsuit was settled on January 12th. Okay, so notice at year end, maybe they had an estimate for this lawsuit. Maybe it was in the footnotes, maybe they didn't have any estimate for it. But if it's settled, notice that we know the dollar amount. So maybe we estimated, hey, look how blurry I am. I'm not usually this blurry. Hey, I'm not blurry anymore. So usually, so let's say they have a lawsuit, let's say the estimated being, making this number up, 15,000. Well, suppose it gets settled and it gets settled for 16,200 or whatever. It makes sense that, okay, the financial statements haven't been put out yet, right? No one is looking at those financial statements yet. They're not audited. It would make sense that for type 1, that you'd say, okay, you got estimated 15,000 on here, but it's actually settled for 16,200. Put that on the books, 16,200, because now we know exactly what it's going to be settled for. So the lawsuit existed before year end, and the subsequent event, the settling of the lawsuit, just gave us more information. So if this is type 1 is for something that existed at the balance sheet date. All right. Type 2. They materially severely damaged. So suppose you have a manufacturing plant, maybe it's one of a few you have, and a tornado comes through and severely damages it. This is the type after year end. So let's say this happens in January 12th. We'll do January 12th again. Okay, subsequent event type 2. These are things that are really big that happened after the balance sheet date, that if people don't know about it, the financial statements may not be very useful to them. For instance, let's say if they only had a handful of manufacturing plants and one of those got knocked out, maybe a quarter of their production got knocked out, it would be good to tell the reader, say, look, these financial statements, this is when they had 3 manufacturing plants, or 4. One of them got knocked out. So don't expect these kind of numbers next year, because it's not going to happen next year. Another thing, maybe they sold part of their business. They made shoes and socks, and they sell the sock business to somebody else. That's a major thing. These are usually major financial structural changes. That you say, look, our revenues and all this stuff on the balance sheet, that this is only sold shoes and socks. Now we only sell shoes, so don't expect these numbers next year. You know, this kind of idea that the financial statements are used for predictive purposes, that only major things are considered type 2. If there's some run-of-the-mill normal thing that happens, we don't worry about that. You know, these are only when there's usually major financial structural changes to the business itself. It got bigger, it got smaller, something happened that changed the business. So the financial statements are not really relevant based on this new information we have after year end, or they're less relevant. Okay, so let's go through. What am I? Client settled a lawsuit that was estimated at year end. Which type?
Type 1.
Yep. The client sold 40% of the common stock to an investor after year end.
Type 2.
Yeah, this is a major structural change. Now that there's someone who owns a considerable amount of the company, going into next year, and the fact that they sold the stock to them, that means they may have more cash on hand to do expansion or something like that. That the financial statements you're looking at are going to be different next year. Client introduced a new product after year end.
Type 2.
This is probably going to be neither. Company, you know, this would be kind of like a general contingency or something like that. It would just be the general part of the business that they come out with new products. So, you know, and two, you know, you don't even know whether they're going to be successful or not. That's kind of a judgment call, anyways, on products themselves. So, normal stuff like this, introducing a new product, they introduce it all the time. The client lost in a fire one of two of their warehouses. I didn't put a time on this.
Maybe type 2.
Yeah, we'll say after year end.
Type 2.
Yep, it is type 2. Yeah, and there's only 2 warehouses, so if they lose one, you know, they've lost half of their warehouses, basically. This one actually, I know of one of this happening. My father-in-law worked for a company called Moog. They make automotive parts. If you look at NASCAR, they almost all have Moog stamped on them. They make a lot of auto parts, but anyways, they had 2 warehouses, and they had like the vice president's kid or something was working, you know, in one of these warehouses as a after school job or whatever. He wanted to leave early to go to a party. He set a small fire, and it burned the place to the ground. They literally, you know, a huge company like Moog, literally, like, they only had 2 warehouses, and one of them burned to the ground in a really weird situation. All right. The client merged with a major competitor after year end.
Type 2.
Type 2. And again, you got to tell the reader, look, don't expect these financial statements. They're not going to be relevant, as relevant, because of these major things that have happened. Okay.
Professor,
Yeah.
in number 3, if the new product was part of a new division, would that make it a type 2 then? Because that would have a major impact on the structure of the company.
It could be. It depends on how, you know, if it was something that they like bought a new division that they were going to start making whatever, you know, shoes, socks, and now we're going to make snow skis, and they bought like a new division. If it had something that was materially financial, that in the structure that changed, yeah. Yep. Yeah, but again, it has to be materially financial in the structure, that there's something different about the structure that's not the same. But yeah, definitely.
Okay,
And these are, a lot of times, these are judgment calls too, okay, they have 2 warehouses, one burns down. Suppose they had 20 warehouses and one burns down. Probably not. I don't know. It's a judgment call. So, there is this idea, well, okay, when is it material? If it's 10%, 20%, what, how much of the production is effective and all that kind of stuff. I'll tell you a funny one. Like I had a friend who they were wrapping up an audit, and they were on their way. They were in the car going to drop off the audit report, and the audit manager was sitting in the car right next to my friend and was reading the Wall Street Journal. And in the Wall Street Journal, it talked about their client that they're going to see had announced a merger, which they didn't know about. They literally found out about it reading it in the Wall Street Journal on the way to, immediately the audit manager said, turn around, we got to go back, and took them another week to get the audit report out. But okay, now the date of the audit report. This is actually kind of important. Oops. This is going to be me clumsily working with my camera. Nope. See, I told you to be clumsy. Here we go. Okay, so it's sort of like this. So let's say this is year end. And I'm just going to use 12/31 just to make it easy. So going through the year here, we'll get our last day of field work. And this is the audit date. So the date on the audit is the last day of field work. So I'm just going to make this up. Let's say that it's February 10th. The audit release date comes after that. Now, usually it's fairly close after, because what happens is they pack up all their stuff, they go back to the CPA firm, and they figure out the audit opinion based on all this evidence. I'm sure they talk it over with the manager and the partner, and could be other people involved too. And let's say that happens on 2/17. Okay, so this is the date of the audit report. So this is the date that's on the audit report. And this is the, can't use that. And this is the audit release date. So this is the date that the audit will be sent out with the financial statements on 2/17. Okay, so on the audit report, date is 2/10. Now, up until the date of the audit report, the auditors must be actively searching for subsequent events. between the audit date and the audit release date is where we must look, but only passively. If something comes to your attention, like you're reading the Wall Street Journal, so, up until this point, you're actively searching for subsequent events. You wrap up the audit, you pack up your stuff, go back to the CPA firm and figure out what audit opinion you're going to give. But here you should be passively looking. In other words, if something comes to your attention, you're required to act upon it. If it doesn't come to your attention, you're not required to act upon it. Okay, so and again, this is the last day of field work. So the general rule is after the last day of field work, you're not responsible. You are responsible for it up until that time. After that, generally speaking, you're not. Now, if something comes to your attention, you should act upon it. If you know about it, obviously you should act upon it up until its release date. Okay, so let's go back to what we're looking at. Date on the audit report. Last day of field work. Auditors must actively search for subsequent events. Oops. All right. Auditors must passively I shouldn't say must. I should say will. Must sounds like you're actually. Now, again, it is possible it doesn't come to their attention, even though something can happen. So generally, they're off the hook after the day of the audit report. Oh, I should say between the audit report date and the audit release date. Oops. So they're going to passively look. All right, any question on that? Okay. We'll do dual dating, then we'll call it a night. Dual dating. Dual dating is, here's what dual dating is. So here's the problem. Let's say that you find something. So you have subsequent event, and let's say that it's found on between 210 and 217. Let's say it's found on 214. Now you have a decision to make. Okay, and here's the decision you got to make for this. Now, here's the audit report, blah, 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 blah. I'm paraphrasing. And the date on the audit report is 2/10. So you find something on 2/14. You could change the audit report to 2/14, but what does that mean? That means you have to then go back and actively look for, if you just change this to that means you have to go back and look for additional things between 210 and 214. Another option, though, is what we call dual dating. Here's your audit report. It's 210. And then it'll have a list of things. So let's say this is subsequent event A. It'll say A is 214. So this could be a dual date. And at this point, you don't need to do any more searching. You say, okay, the audit report is 210. However, there is a subsequent event. Oops. That happened, but that's the only thing that we looked at on 214. We didn't actually do anything else looking. So this is dual dating. I've seen audit reports that had 6 of those. A company that's really going through a lot of change, it's not that unusual to have a whole bunch of them listed. So, and two, at some point you got to wrap this audit up. You can imagine if there's a lot of things happening, this could theoretically go on forever. If you don't draw a line and say, okay, this is the date, everything that happens after, we're just going to put an extra date in. So dual dating is when you have more than one date on the audit report. I'm forgetting the B. Dual dating, dual dating actually could be many more than 2, it could be more, but they call it dual dating. So when there's more than one date, and it's for things that happen after the last day of fieldwork. So we'll still keep the last day of fieldwork, but we'll put an extra date on for anything that we find after that. So a dual dating report, that's simply adding things on without having to actively look. You could do this. You could change the date so that everything is on 214. Do some more looking between 210 and 214, and then try to get the report out. But yeah, so you can either change the date for everything or else do this dual date. And like I say, I've seen these with multiple ones on it. So it does happen quite a bit. All right, let's stop there. It's too nice out. We have to get out of here. So we'll pick this up next week. There'll only be one more test in here. We're at week 13. This goes up to week 16. So there'll be one more. There'll be one more test, and hey, that's not me. I'm going to. So we'll put them together. So we're definitely going to have this end of the audit handout on there. The audit report chapter, which is chapter 17. We'll have on there. We might do a little bit in chapter 18, which are special reports, but certainly chapters 16 and 17 will be on the final. But there's only gonna be one more test, and there is no comprehensive final or anything like that. It'll just be the last test. I am going to send out the sampling exam, and that will be due. Maybe 21st. Okay, I'll send out the sampling exam tonight. Any questions? Okay, see you guys next week.
See ya. Thank you so much.
Bye, guys.
Have a good night. Thank you.